difficult this year. You say the path is likely to get much bumpier. You're looking for gains, obviously, out of the S&P, but 7,300 to 7,500 by year end. What's your view? This is your new outlook, which is out.
Yeah, we just published it today, and we think this. We're aligned with what Josh was saying in financials. We're very aligned with Shannon. I think about this. If you go back and look at big bull markets, year 3 of the bull market is usually the worst in the first 5 years, okay? I think we're probably going to have the year 3 of the bull market in year 4. High single digit, low double digit returns for the S&P 500, low double digit returns for Canada. Here's why. You've had some of the fundamental issues with respect to tech. We neutralized tech in our holdings, by the way. We're going to be overweight communication services, financials, and utilities. Why? I think because you can afford yourself higher amounts of tracking error with respect to those 3 sectors in particular. In terms of the longer term secular earnings growth mode, our theme of scale in financials is still very much in place. As you've joked with me for years, financials, financials, financials. We believe those assets are still actually under-owned by a lot of institutions. And then lastly, we believe that we're going to see a rotation into 3 equity disciplines this year: value, dividend growth, and small mid-cap. Small mid-cap, to us from a fundamental perspective, looks amazing with respect to free cash flow, and we think we're going to see a tremendous amount of M&A activity in the small mid-cap space.
Do you, look, I'm not going to say your outlook for the market is, I don't even know if I'd use the word cautious. I mean, it's not a bad outlook, but relative to what we've done the past few years, it looks more
sanguine.
Okay, it's sanguine. Now, if you would say, okay, the 24 and 23% gains that we got out of the S&P 2 of the last 3 years, you had a lot of multiple expansion, and now you finally have earnings growth.
Yep.
Can I make the leap and say that you don't think that there's going to be enough earnings growth to justify a bigger move in the market, because it's not going to come from multiple expansion now, because the stock market is already at 22 times, and how much more can you get a multiple to expand?
It's a great take. So if you go back and look and do an historical study of bull markets, when the bull market transitions into more of an earnings-driven market, which we're having, we believe, in 2026, the returns historically are much less, and in fact could be half as much when the market is expanding with respect to momentum in terms of a valuation-driven market. That's the kind of market that we think we're going into in 2026, an earnings-driven market. And oh, by the way, that's still positive. Positive is still positive. Just because the market isn't going to be up, we believe, as much as last year. I hope we're wrong. I hope the market just continues to go up at the same pace. I really do. But for all intents and purposes, we think earnings-driven markets, based on our research and based on where we want to be positioned in the U.S. market, we think we'll have those high single-digit, low double-digit returns.
You have a pretty